Welcome back to The Explainer. I am absolutely thrilled to have you here today because we are tackling something that has become a massive headache for so many investors lately. If you've been feeling anxious, confused, or just totally lost about what is going on with ELSS mutual funds under the new tax regime, well, take a deep breath because you're in the right place. We're going to dive straight into this major shift, cut through the noise, and figure out exactly how you can navigate it to protect and grow your wealth. You can save tax under Section 80C. Let's be real for a second. That is probably the exact phrase that convinced you to start investing in an ELSS fund in the first place, right? Somebody, maybe a friend, a financial advisor, a parent, told you it was basically a golden ticket, a way to save on your taxes while riding the highs of the stock market.
But fast forward to today, you've switched to the new tax regime, and suddenly you're hit with a pretty shocking reality. Your ELSS investment doesn't give you that magical Section 80C deduction anymore. So what on earth do you do now? Is your ELSS completely useless? Should you halt your SIPs right this second, pull all your cash out? Or should you completely backtrack to the old tax regime just to get that one deduction? Look, there is a lot of panic out there right now, but today we are going to clear it all up.
To cure this financial anxiety, we've got a super clear roadmap for today. Number 1, the new tax regime shock. 2, your existing ELSS investments. 3, rethinking your ELSS SIP. 4, alternatives to consider. And finally, number 5, a 5-step decision framework. All right, let's jump right into Section 1, the new tax regime shock. To really wrap our heads around what's happening here, we need to strip things down to first principles. What actually is an ELSS? It stands for Equity-Linked Savings Scheme. But at its absolute core, it is just an equity mutual fund. That means its returns are tied directly to the stock market. It's totally subject to market volatility, it goes through periods of negative returns, and there are absolutely zero guaranteed returns. It also comes with a mandatory 3-year lock-in for every single investment you make. The magic trick was always that it combined equity investing with a tax-saving provision under the old regime. And honestly, that dual identity is exactly where all this current confusion stems from.
So let's put these two regimes side by side for a second. The new tax regime was purposely built around offering lower tax rates, but in exchange, it gives you way fewer deductions. Because, the taxman always finds a way to balance the scales. The current rules clearly state that when you opt for the new tax regime, most of your traditional Chapter 6A deductions, including Section 80C, are disabled. That means your PPF, your tax-saving fixed deposits, life insurance premiums, and yes, your ELSS generally won't give you a tax break anymore. But here is the literal game changer you need to understand. The investment doesn't stop existing just because you chose the new tax regime. You simply just don't get the tax deduction for it.
Moving right along to Section 2, your existing ELSS investments. So what in the world happens to the money you've already parked in ELSS funds from previous years? Well, first and foremost, the magic number is 3. That mandatory 3-year lock-in, it still firmly applies. If you invested money 3 years ago, or literally just last year under the old regime, that specific lock-in clock is still ticking away based on your individual investment dates. You can't just suddenly withdraw it early because you changed your tax filing status. And this perfectly highlights one of the biggest misconceptions we need to debunk today. Your existing ELSS is absolutely not useless. The money doesn't just evaporate into thin air. You still own those exact same mutual fund units. Your hard-earned money is still invested in that underlying equity portfolio, riding the market's everyday risks and returns. Please don't fall into the trap of thinking, hey, I'm in the new tax regime now, so my past ELSS investments are totally dead. The tax deduction and the investment itself are two completely separate things. Now, we do have to talk about what happens when you finally decide to withdraw after that lock-in period ends. Because, unfortunately, the taxman always gets his due eventually. Since ELSS is an equity mutual fund, when you redeem it, capital gains taxes apply. Under the current rules for equity-oriented investments, there's an annual exemption threshold of 1.25 lakh rupees for eligible long-term capital gains. Any gains above that threshold are taxed at 12.5%. To put that in perspective, if your gains are 1 lakh, you're safe within the exemption. But if they're 2 lakh, that amount over the threshold gets taxed. The main takeaway here is simply this: ELSS does not mean tax-free forever. Which brings us to Section 3, rethinking your ELSS SIP. Okay, so we've secured your past investments, but what about your active ELSS SIPs? Should you go ahead and pause that monthly auto deduction?
To make sense of this, let's ground all this abstract tax math in a super relatable scenario. Meet our imaginary investor, Rahul. Rahul pulls in 12 lakh rupees a year and has been dutifully putting 1.5 lakh into an ELSS fund. Under the old regime, he maxed out his ADC limit flawlessly. But now he's shifted to the new tax regime, and poof, he loses that specific deduction. So Rahul has a real dilemma. Should he just stop his ELSS entirely, or should he switch all the way back to the old tax regime just to claim that 1.5 lakh deduction? The reality is, you have to look at the bigger picture and calculate your total tax liability. The new regime offers lower slab rates overall, so the right question for Rahul isn't how can I claim this one specific deduction, it's actually which tax regime gives me the lowest overall tax bill after looking at all my eligible deductions. Don't blindly flip your entire tax strategy upside down just to save one ELSS investment.
Now, if Rahul runs the numbers and realizes the new tax regime is still mathematically way better for him, he has to decide what to do with his ongoing SIP. And that brings us to the absolute most powerful direct question you can ask yourself today. Would I choose this exact same fund today if there were zero tax benefits attached to it? Think of this as a total mental reset. If the only reason you held onto this SIP was for the tax savings and that benefit is gone, why on earth are you still accepting a mandatory 3-year lock-in? On the flip side, if you genuinely love the fund's equity exposure, its long-term strategy, and the fund manager's track record, then losing the ADC deduction doesn't automatically mean it's a bad fund.
Let's move into Section 4, Alternatives to Consider. So, what if you answered no to that last question? You realized you literally only bought the fund for the tax break. Well, then it's time to shift gears. If ELSS no longer fits your strategy, there are some incredibly good alternatives out there. If you still want that equity exposure but absolutely hate the idea of a 3-year lock-in, you might want to look into index funds for really broad, simple market exposure. Or maybe flexi-cap funds if you prefer active management across different company sizes. Now, if you are strictly hunting for tax benefit under the new regime, you've got to look closely at NPS. Specifically, employer contributions to NPS under Section 80CCT2 can actually still offer a deduction under the new regime, subject to certain limits, of course. Just keep in mind that your own extra 50,000 rupee contribution under 80CCT1B is strictly for the old regime, but that employer portion, that's a massive tool for eligible salaried employees. And finally, there's always the classic PPF. Sure, you don't get the ADC deduction for putting money into it under the new regime, but its tax-free interest and maturity still make it a wonderfully stable, tax-efficient long-term savings tool. And now our final section, Section 5, 5-Step Decision Framework. Okay, we've covered a ton of ground today, which brings us to our grand finale. This is a framework designed to completely cure your financial anxiety and create a permanent, healthy shift in your mindset. You see, the biggest mistake investors make is starting with the question, how can I save tax, and then just blindly buying literally whatever product hands them a deduction. We really need to break away from this pure tax-saving mindset, which is entirely obsessed with just reducing your current tax bill. Instead, we need to flip the script to a wealth creation mindset. This is all about intentionally growing your money over a long period based on your actual life goals. Do these concepts overlap? Sure, sometimes, but they are not the same thing. ELSS was wildly popular because it did both simultaneously, but under the new regime, we have to evaluate it strictly as a wealth creation tool. So to actually put that wealth creation mindset into action, I want you to follow this brilliant 5-step paradigm shift. Step 1. Decide your tax regime based on the total math of your income, not just one single financial product. Step 2. Identify your actual financial goal. Is this money for retirement, a new house, your kids' education? Step 3. Decide your asset allocation. How much risk can you actually stomach? How much should be in equity versus debt? Step 4. Select the specific investment. Is it an index fund, a flexi cap, or hey, maybe it's still an ELSS if it fits your portfolio perfectly? And finally, Step 5. Consider tax efficiency. Did you notice where tax is on this list? It is the absolute last consideration, not the first. Please do not let the tax tail wag the investment dog. Which brings us right back to the ultimate takeaway of this entire explainer. If ELSS didn't offer a tax deduction, would you still want to own this equity fund? If your answer is an enthusiastic yes, then keep going. The fund is doing exactly what it's supposed to do in your portfolio. But if your answer is no, then it is absolutely time to reassess your strategy using the framework we just walked through. Remember, your investments should serve your goals, not just your tax filing. I really hope this structured breakdown has empowered you to look at your portfolio with some incredible clarity today.
Go review your funds, ask the hard questions, and most importantly, invest for your long-term wealth. Thank you so much for joining me in this explainer. Keep learning, keep growing, and I will see you in the next one.